Good afternoon, everyone. Today, we will discuss about Module 8 entitled Financial Literacy. So here are the learning outcomes. First, define financial literacy. Second, distinguish among financial plan, budgeting, saving, spending, and investing. Third, present ways on how to avoid financial crises and scams. Fourth, demonstrate understanding of insurance and taxes. Fifth, describe a financially stable person. Sixth, determine ways on how to integrate financial literacy in the curriculum. 7. Draw relevant life lessons and significant values from personal experiences on financial crises and scams. 8. Analyze research abstracts on financial literacy and its implications to the teaching's learning process. 9. Make a personal financial plan based on short-term and long-term goals. Financial literacy is the ability to make informed judgments and make effective decisions regarding the use and management of money. Financial literacy is a core life skill in an increasingly complex world where people need to take charge of their own finances, budget, financial choices, managing risk, saving, credit, and financial transaction. Poor financial decisions can have a long-lasting impact on individuals, their families, and the society caused by lack of financial literacy. Low levels of financial literacy are associated with lower standards of living, decreased psychological and physical well-being, and greater reliance on government support. However, when put into correct practice, financial literacy can strengthen savings behavior, eliminate maxed-out credit cards, and enhance time debt. The importance of starting financial literacy while still young. National surveys show that young adults have the lowest levels of financial literacy, as reflected on their inability to choose the right financial products and lack of interest in undertaking sound financial planning. Therefore, financial education should begin as early as possible and be taught in schools. ACTAG 2013 stressed that in the recent financial crisis, financial literacy is very crucial and tends to be advantageous if introduced in the very early years as preschool years. Financial education is a long-term process, and incorporating it into curricula from an early age allows children to acquire the knowledge and skills while building responsible financial behavior throughout each stage of their education. OECD 2005. Financial Plan. Kagan 2019 defines a financial plan as a comprehensive statement of an individual's long-term objectives for security and well-being and detailed savings and investing strategy for achieving the objectives. Teachers need to have a deeper understanding and capacity to formulate their own financial plan. It is wise to consider starting to plan the moment they hand in their first salary, including the incentives, bonuses, and extra remunerations that they receive. So here are the following steps in creating a financial plan. Number 1. Calculating net worth. Net worth is the amount by which assets exceed liabilities. In so doing, considered first is assets that entail one's cash, property, investments, savings, jewelry, and wealth. And second, liabilities that include credit card debt, loans, and mortgage. So the formula we will use is total assets minus total liabilities equals current net worth. Number 2. Determining cash flow. A financial plan is knowing where money goes every month. Documenting it will help to see how much is needed every month for necessities and the amount for savings and investments. Number 3. Considering the priorities. The core of a financial plan is the person's clearly defined goals that may include: first, retirement strategy for accumulating retirement income. Second, comprehensive risk management plan including a review of life and disability insurance, personal liability coverage, property and casualty coverage, and catastrophe coverage. Third, long-term investment plan based on specific investment objectives and a personal risk tolerance profile. And fourth, tax reduction strategy for minimizing taxes on personal income allowed by the tax code. Financial literacy shapes the way people view and handle money. The following are financial improvements suggested by Investopedia as a journey to financial literacy. Number 1. Identify your starting point. Calculating the net worth is the best way to determine both current financial status and progress over time to avoid financial trouble by spending too much on wants and nothing enough for the needs. Number 2. Set your priorities. Making a list of rated needs and wants can help set financial priorities. Needs are things one must have in order to survive, like food, shelter, clothing, healthcare, and transportation. While wants are things one would like to have but are not necessary to survival. Number 3. Document your spending. One of the best ways to figure out cash flow or what comes in and what goes out is to create a budget or a personal spending plan. A budget lists down all income and expenses to help meet financial obligation. Number 4. Lay down your debt. Living with debt is costly not just because of interest and fees, but it can also prevent people from getting ahead with their financial goals. Number 5. Secure your financial future. Retirement is an uncontrollable stage in a worker's life, of which counterpart are losing the job, suffering from an illness or injury, or be forced to care for a loved one that may lead to an unplanned retirement. Therefore, knowing more about retirement options is an essential part of securing financial future. Financial goal planning and setting. Setting goals is a very important part of life, especially in financial planning. Before investing the money, consider setting personal financial goals. Financial goals are targets usually driven by specific future financial needs, such as savings for a comfortable retirement, sending children to college, or enabling a home purchase. So there are 3 key areas in setting investment goals for consideration. First, time horizon. It indicates the time when the money will be needed. To note, the longer the time horizon, the more risky investments can be made. Next, a risk tolerance. Investors may let go of the possibility of a large gain if they knew there was also a possibility of a large loss, while others are more willing to take the chance of a large loss if there were also a possibility of a large gain. The time horizons can affect risk tolerance. Next is liquidity needs. Liquidity refers to how quickly an investment can be converted into cash. The liquidity needs usually affect the time of choosing investment to meet the goals. Next is investment cost, growth, income, and stability. Once determine the financial goals and how time horizon, risk tolerance, and liquidity needs affect them. It is time to think about how investments may help achieve those goals. When terms of 3K investment goals, growth, also known as capital appreciation, is an increase in the value of an investment. Number 2, income, of which some investment make periodic payments of interest or dividends that represents investment income and can be spent or reinvested. And 3, stability, or known as capital preservations or protections of principal. Budget and budgeting. A budget is an estimation of revenue and expenses over a specified future period of time and is usually compiled and re-evaluated on a periodic basis. Budgets can be made for a variety of individuals or business needs or just about anything else that makes and spends money. Budgeting, on the other hand, is the process of creating a plan to spend money. Creating this spending plan allows one to determine in advance whether he or she will have enough money to do the things he or she needs or likes to do. So, here are the following 7 steps that may help in attaining good budgeting. Step 1. Set realistic goals. Goals for the money will help make smart spending choices upon deciding on what is important. Step 2. Identify income and expenses. Upon knowing how much is earned each month and where it all goes, start tracking the expenses by recording every single cent. Step 3. Separate needs from wants. Set clear priorities and the decisions become easier to make by identifying wisely those that are really needed or just wanted. Step 4. Design your budget. Make sure to avoid spending more than what is earned. Balance budgets to accommodate everything needed to be paid for. Step 5. Put your plan into action. Match spending with income time. Decide ahead of time what you will use each payday. Non-reliance to credit for the living expenses will protect one from debt. Step 6. Plan for seasonal expenses. Set money aside to pay for unplanned expenses so to avoid going into debt. Step 7. Look ahead. Having a stable budget can take a month or two, so ask for help if things are not getting well.
Spending. If budget goals serve as a financial wish list, a spending plan is a way to make those wishes a reality. Turn them into an action plan. The following are the practical strategies in setting and prioritizing budget goals and spending plan. So the first one, start by listing your goals. Setting budget goals requires forecasting and discussing future needs and dreams with the family. Second, divide your goals according to how long it will take to meet each goal. Classify your budget goals into 3 categories: a short-term goals less than a year, the medium-term goals 1 to 5 years, and the long-term goals more than 5 years. The short-term goals are usually the immediate needs and wants. The medium-term goals are things that you and your family want to achieve during the next 5 years. And the long-term goals extend well into the future, such as planning for retirement. Third is estimate the cost of each goal and find out how much it costs. Before assigning priority to goals, it is important to determine the cost of each goal. The greater the cost of the goal, the more alternative goals must be sacrificed in order to achieve it. Fourth is project future cost. For short-term goals, inflation is not a big deal or factor, But for medium and long-term goals, it is a big factor. To calculate the future cost of the goals, there is a need to determine the rate of inflation applied to each particular goal. Fifth is calculate how much you need to set aside each period. Upon knowing the future cost of the goals, next is to determine how much to put aside each period to meet all the goals. Sixth is prioritize your goals. Upon listing down all the goals and the estimated amount needed for each goal, prioritize them. This serves as a guide in decision making. And lastly, create a schedule for meeting your goals. It is important to lay down all the goals according to priority with a corresponding amount of money needed, the time it will be needed, and the installments needed to meet the goals. Investment and investing. As teachers, when you have saved more money than what you expect at the time of need, consider investing this money to earn more interest than what your saving account is paying you. There are many ways you can invest your money, but consider the four aspects. The first aspect is how long will you invest the money or the time horizon. Second, how much money do you expect your investment to earn each year or the expectation of return. Third is how much of your investment are you willing to lose in the short term in order to earn more in the long term or the risk tolerance. And lastly, what types of investment interest you or the investment type. Savings. In order to get out of debt, it is important to set some money aside into a saving account on a regular basis. Savings will also help in buying things that are needed or wanted without borrowing, just like emergency saving fund. Start as early. Setting aside a little money for emergency saving fund. If you receive a bonus from work, an income tax refund, or earnings from additional or side jobs, use them as an emergency. 10 reasons why save money. With credit so easy to get, here are 10 practical reasons why is it important to save money that everyone, including teachers, must know. The first one, to become financially independent. Financial independence is not having to depend on receiving a certain pay, but setting aside an amount to have savings that can be relied on. Second, to save on everything you buy. With savings, you can buy things when they are on sale and can make better spending choices without being compromised on credit card interest charges. Third, to buy a home or a car. Savings can be used in buying a home in full or down payment, especially in times of promo deals, bids, and inevitable sale at a reasonable interest rate. Fourth, to prepare for the future. Through savings, you can be confident to face the future without worrying on how you will survive. Fifth, to get out of debt. If you want to get out of debt, you have to save money. Sixth, to augment annual expenses. In order to attain a good stress-free financial life, there is a need to save for annual expenses in advance. Seventh, to settle unforeseen expenses. Savings can respond to unforeseen expenses in times of need. 8. To respond to emergencies. Emergencies may happen anytime, and this can be expensive, so there is a need to get prepared rather than potentially become another victim of an emergency. 9. To mitigate losing your job or getting hurt. Bad things can happen to anyone, such as losing a job, business bankruptcy or crisis, being injured or becoming too sick to work. Therefore, having savings is the key to resolve such a dilemma. And lastly, to have a good life. Putting aside some money to spend when needed can bring about quality and worry-free life at all times. Here are some of the common financial scams along with ways to identify them early and how to protect oneself from being victimized. So the first one is phishing. Using these common tactics, scammers send an email that appears to come from a financial institution, such as bank, and ask you to click on a link to update your account information. If you receive any correspondence that asks for your information, never click on the links or provide account details. Instead, visit the company's website, find official contact information, and call them to verify the request. Second, social media scams. Scammers are adept at using social media to gather information about the traveling habits of the potential victims. They also have phishing tactics, including posts seeking charity donations with bogus links that allow them to keep your money. Therefore, be conscious of the information you post online, especially personal details and plans for a vacation that you would leave your house unoccupied. The third one is phone scams. Another prevalent tactic is scamming phone calls. The scammers pose a government agencies such as the Bureau of Internal Revenue or local law enforcement agencies, and use scare tactics to acquire your personal information and account number. Never provide your account information over the phone. Look for the agency's contact information and call them to verify any request. To note, government agency will never text or call you to ask for money. The fourth one is stolen credit card numbers. There are numerous ways that scammers can credit card information, including hacking, phishing, and use of skimming devices, such as small card readers attached to unmanned credit card readers like ATMs, gas pumps, and more. These small devices pull data from your card when you swipe it. Before you use an ATM or swipe your card, look for suspicious devices that may be attached to the card reader. And lastly, identity thieves. Depending on the amount of information a scammer is able to obtain, identity thieves may extend to be an unauthorized charges on a debit or credit card. If scammers are able to obtain your social security number, date of birth, and other personal information, they may be able to open new accounts in your name without your knowledge. Be aware of any information you share and with whom, and always shred sensitive information before disposing it. 10 tips to avoid common financial scams. Every year, fraud cases are getting worse, leaving countless victims in trouble and danger through data breaches, identity theft, and online scams. Unfortunately, new and improved technology only gives fraudsters an edge, making it easier than ever for scam artists to nab financial data from unsuspecting consumers. The first one is never wire money to a stranger. Second, don't give out financial information. Third, never click on hyperlinks in emails. Fourth, use difficult passwords. 5. Never give your social security number. 6. Install antivirus and spyware protection. 7. Don't shop with unfamiliar online retailers. Don't download software from pop-up windows. 9. Make sure the websites you visit are safe. And lastly, donate to known charities only. Financial scams among students. Students can also be susceptible to different financial scams and fraud. Learning how to manage finances and being aware of financial scams are skills that every student should master. The following are common financial scams that students should watch out for and learn to protect one's identity and finances. The first one is fake scholarship. While it is beneficial for students to apply for as many scholarships, it is important to become aware of related scams and frauds. Students should thoroughly check scholarship sources before applying to verify legitimacy. Never apply for a scholarship that asks for money in return. Second is diploma mills. There are schools that offer fake degrees and diplomas in exchange for a fee. Check from government education agencies and prospective school to enroll if it is government recognized, legitimate, or accredited. Third, online book scams. While students often go for the best deals on textbooks online, scammers can use this opportunity to get students' credit card information. When buying anything online, be sure to do it on a credible site. And lastly, credit card scams. Oftentimes, credit card companies go to school campuses to convince students to fill out card applications. Scammers may also grab this chance to steal students' information. It is important to visit a local credit union or bank for credit card application. Also, regular check the credit card statement. And once there are any unrecognized charges, contact your banking institution immediately.
Insurance and taxes. Insurance is a content in the form of policy between the policyholder and the insurance company, whereby the company agrees to compensate for any financial loss from specific insured events. There are various types of insurance to choose from, such as life insurance, health insurance, motor insurance, property insurance, business insurance. Besides, the financial protection derived from insurance entails tax benefit claim on the paid premiums. The following are concepts related to insurance and taxes that every teacher should know. First, employer-sponsored insurance. If working in a company with 50 or more full-time employees, the employer is required to provide employee-only insurance that meets minimum guidelines. Second, market plans. Market plans are available based on an area of residence and income upon meeting minimum coverage requirements. Marketplace plans comes in 3 tiers: bronze, silver, and gold. Generally, bronze plans offer the least coverage of the lowest premiums, while gold plans provide the most coverage at the highest price. Life insurance. Life insurance is a type of insurance that compensates beneficiaries upon death of policyholder. The company will guarantee a payout for the beneficiaries in exchange of premiums. This compensation is called death benefit. The following are common risk categories. First, preferred class. The policyholder is in excellent health with normal weight, no history of smoking, chronic illnesses, or family history of any life-threatening disease. Second is preferred. The policyholder is in excellent health but may have minor issues on cholesterol or blood pressure but under control. Third, standard plus. The policyholder is in very good health but some factors like high blood pressure or being overweight impede a better rating. Fourth, standard. Most policyholders belong to this category as they are deemed to be healthy and have a normal life expectancy, although they maybe have family history of life-threatening diseases or a few minor health issues. Fifth, substandard. Those with serious health issues like diabetes or heart disease are placed on a table rating system ranked from highest to lowest. 6. Smokers. Due to an added risk of smoking, the policyholders in this category are guaranteed to pay more. Benefit of insurance. The following are the benefits of life insurance. First, it pays for medical and funeral costs. Life insurance helps solve the incurred expenses for medical and funeral services to lessen the grief among family and relatives for being unprepared. Second, for financial support. Life insurance can become a source of temporary income during the difficult period of adjusting and coping the loss of loved one, especially if she is the breadwinner. Third, for funding various financial goals. Life insurance offers additional benefits through the form of fund accumulation for specific future financial goals. Fourth, acts as a retirement secured conform. Modern life insurance also serve as a tool of principal holders can use to get in a better financial position in the future. Fifth, it covers costs incurred from taxes and debt. Life insurance can serve or protection since the premium be used to pay for unsettled debts and taxes. Next, types of insurance. The table below shows a comparative analysis of different types of life insurance along characteristics, advantages, and disadvantages that may serve as a reference. Type number 1, endowment. In characteristic, it grants a lump sum after a specified amount of time or upon death. The policy owner is required to pay the premium for a predetermined number of years or until a specific age of reach. Advantages: it allows for saving up for specific purposes. It guarantees returns upon maturity. It offers some form of insurance coverage. Disadvantages: it requires higher premium than other types of life insurance. It is not the best option for those looking for full life protection. Type number 2, term. The characteristic: it is the simplest form of life insurance to obtain, of which upon death, the beneficiaries are paid with the benefit. Advantage: it entails low premium requirements. It is a strong option for policyholders who need insurance but cannot afford whole life or endowment. It is easy to understand. The disadvantage: it has no benefit to policyholder, outlives the term period set. Premium usually gets higher upon renewal of terms. The third types is whole life. Characteristic: it provides coverage for policyholders' entire life or until they reach 100 years old. It acts both as protection and savings mechanisms since a portion of the premium is allowed to build up cash values. The advantage: it offers permanent protection for full life or 100 years. It is flexible in terms of payments of premiums, and it entails fixed premiums. It usually comes with additional features and living benefits. The disadvantage: it incurs higher premium. It is difficult to understand due to complexity. The fourth type is variable, universal life or VUL. The characteristics: it serves as both life protection and investment vehicle in one package. A portion of the premium is allocated into various investment vehicles for the purposes of wealth creation. The contract's earnings are based on performance of selected investment. The advantage: it takes dual purpose, life insurance plus investment tool. It has no maturity age. The cash value is payable along with the assured sum. The debt component is not limited to face value. It depicts liquidity wherein funds can be accessed in times of need and can serve as emergency funds. The disadvantage: cash values and dividends are not guaranteed. Face amount of debt benefit are dependent on investment performance. It includes various investment fees. Financial stability. Like anyone else, teachers also aim to become financially stable, if not today, maybe in the future. Being financially stable means confidence with the financial situation, worries, paying the bills because of available funds, debt, free money savings for future goals, and enough emergency funds. 10 strategies in reading financial stability. First, make savings automagical. Savings should be made a top priority, especially as an emergency fund and a bill payment from the amount are automatically transferred from the checking account, like an online savings account. Second, control your impulsive spending. Control yourself from impulsive spending on eating and shopping and online purchases that may ruin your finances and budget. Third, evaluate your expenses and live frugally. Analyze how you spend your money, see what you can reduce, and determines expenses that necessary and eliminate the unnecessary. Fourth, invest in your future. Start preparing and investing in your future retirement while still young in your career field. Fifth, keep your family secure. Save for an emergency fund so that you have something to spend if anything happens with the family emergently. 6. Eliminate and avoid debt. Eliminate credit cards, personal loans, or other debt forms as it will not work on you but even pull you down and make you drawn with obligation that may even result to surrendering your properties, jewelry, and investments as payment. Number 7. Use the envelope system. Set aside 3 amounts in your budget each payday. Withdraw those amounts and put them in 3 separate envelopes. In that way, you can easily track how much remains for each of the expenses or if you already run out of money. Number 8. Pay bills immediately. One good habit is to pay bills as soon as they come and try to get your bills to be paid through automatic deduction. 9. Read about personal finances. The more you educate yourself, the better your finances will be. 10. Look to grow your net worth. Do whatever you can to improve your net worth, either by reducing your debt, increasing your savings, or increasing your income, or all of the above. Signs of being financially stable. Teachers, like anyone else, often for work to extend to earn more and even through additional jobs on the side just for their desire for financial stability. Rose 2019 presents some signs of financially stable person. First, you never withdraw your checking account. Second, you don't lose sleep over finances. Third, you use credit cards for convenience and rewards but never out of necessity. Fourth, you don't worry about losing your job. Fifth, you pay your bills ahead of time. Number 6, people ask your opinion about financially matters and you inspire them. 7, you're generally happy with your financial situation. 8, you finance your cars over 5 years or less if you take loans at all. 9, you distribute more to your retirement. 11, you can afford to buy the things you really want. 12, recreation if spending doesn't appeal to you. 13, you're a nature saver. 14, you're generous with money when it comes to charities or helping others. 15, you're confident about your future. 16, your net worth grows significantly from year to year. 17, you have substantial equity in your home. 18, you consistently live beneath your means. 19, you could survive for months without a paycheck. 20, you feel in control of your finances and never dominated by them. Integrity financial literacy into the curriculum. Financial education in schools should be part of a collaborative national strategy to ensure relevance and long-term sustainability. The education system and profession should be involved in the development of strategy. In support, Barry 2013 underscored that financial literacy has a wide repercussion outside the family circle and more precisely the school. Hence, administrators and professors need to develop a curriculum that would provide students insights on having the value of financial literacy, including the effect it can bring them.